good conversation. I'm hoping that we get some good conversation going here, talking about issues that you've come up with, because I think that, we were discussing before you all joined on the call, this is going to be an interesting time because number one, we can talk about inventory till we're blue in the face. We know that that's lacking. That's number one. And number two, we need to position ourselves to deal with, I think possibility is very strong that interest rates are going to start to go up. But I'm going to ask everyone, if you would please, to come off mute and let me know if you're able to get on this Kahoot. It's kind of fun, but I just want to know if everyone's able. So I can't see people's faces. Kelly, are you able to use another device and get on to my Kahoot?
I'm on mobile at the moment. I'm not sure if that precludes me from using it.
All right, and Paul's iPhone. I think that was.
Can't hear
I don't think that was Paul, was it?
Yeah, but I'm driving right now, so I'm going to
Okay.
refrain.
Okay, so we're gonna and then Kathleen.
Yes, I'm able to get on the screen with the snowman.
Ooh, okay. If we have a couple, we'll do it because even though you can't play, you can watch along. And then whoever is calling from the accounting department.
Oh, yeah, I don't see the snowman yet.
All right, who's can you unmute from accounting and documents? Okay, you know what? This might not work for today, so we will.
Sorry.
No, don't apologize. That's fine. It's just kind of interesting. The one thing I really like about give me a second to regroup here. The one thing I like about this Kahoot, anyone who's taken a class of mine knows that we do this for every class because it really does begin to highlight give me a second. I just got to regroup.
Cherie, I'm a little disappointed because I expected to beat everybody today.
I'm so sorry. So sorry.
Hey, Anthony.
Hi, Paul. With my my knowledge base, I thought that this might be the class that I can beat everybody in.
Maybe. One would certainly hope now.
Of course, they don't want to go against me today.
All right. Okay, let's get going. So again, the most important thing here is let's get to the issues that you want to get to. And some of the things that we're going to be looking at, if I can get this shared. Okay, are we there? Can everyone see my screen? Give me a thumbs up or thank you. Okay, so again, we're going to get into some of the issues. You've got myself on the phone. Hey, Thomas, saw you just joined. We've got Anthony on the phone. You got two mortgage reps that know their stuff. So bring it on, ask questions. What kind of things, do you maybe some situations that you've gotten into and you weren't quite sure how to resolve. And then I think we should take a couple of minutes and talk about market conditions and see what y'all think. And maybe some people have some thoughts. It's going to be interesting to see what 2022 is going to look at. Would anyone agree with me on that?
Absolutely.
Anyone? Okay. All right. Top 5 mortgage mess ups that can delay your closing. Now, I just want to let you know that where this kind of came from was a survey to some lenders and attorneys, because sometimes these mess ups happen towards the end. So these are real life things. I think, Anthony, you're going to agree with me on that. Okay, contribution versus concession. Do you guys realize that there's a difference to that? Anyone? So you can all come off mute. Let's all talk together. Anthony, is there a difference between contribution and concession?
Correct.
Is it a big difference?
It is a big difference.
Can it kill your deal?
It absolutely can.
Absolutely can. So contribution is interested party contributions. They're costs that are normally the responsibility of the property purchaser that are paid directly or indirectly by someone else who has a financial interest in or can influence the terms and sale or transfer of the subject property. Okay, so what's your typical seller contribution?
Closing costs, prepaids,
Costs.
escrows.
Closing costs, prepaids, and escrows. I had a situation recently on a Newport condo. I'm going to get into concessions for a moment. It was a $1.2 million transaction, and they were new condos, and the builder hadn't released yet control of the HOA because he didn't have enough in pre-sold and whatnot. So he wanted to keep his price at 1.2 to make sure he could resell or sell the other condos at 1.2. So what he did, because there was a buyer that came in who was just very firm on his price, and it would have brought the price down to 1.18 or something of that nature. So the builder came back and he said, I will pay 2 years worth of your HOA dues, which came out to be $24,000, if you will go 1.2 million on the price. And they agreed, but that was considered a concession. Okay. In other words, it was an inducement, like a builder offering a car or furniture, a fully furnished house. We have to talk about those kinds of things. Those are considered concessions. They are not contributions. So any agent on the call, have you ever gotten a call from a loan officer saying, hey, can you remove the personal property in the sales agreement?
Yes.
Okay. And that there is the reason why. So if there is anything going into the transaction that basically is not affixed to the property or part of the actual real property, if you keep that in the contract, then what we have to do is we have to have an appraiser, not a real estate appraiser, but an appraiser that would appraise whatever you're leaving, put a value on that property, and we're going to decrease the loan amount or the sale price by that value, ultimately meaning the buyer has to come in with a higher down payment. So one way or another, they're doing it for cash. So what are some solutions to that when you have that kind of situation? What have you guys done in the past? Anyone? So whoever said yes, you've had that call. What did you do to resolve that?
Probably rewrite, either adjust like the sale price instead of writing into the contract some kind of a seller concession contribution.
Yeah, one thing you can do is sell the items on a separate contract for $1. So you keep the sale of that personal property separate from the contract.
That
There
makes
are,
sense.
depending on how much is being left, if it's minimal, sometimes you can get away with putting right in the contract, sellers leaving, I don't know, riding lawnmower at their convenience. They don't want to take it. So sometimes you can do a seller's leaving it as a convenience. But if you write that stuff into a contract, the point of this is you're going to have to deal with it, and you don't want to wait till the end of a transaction to deal with it. Anthony, do you have anything to say about that?
Usually it's just the only thing that usually pops up now is, especially like FHA, the personal property being transferred at $0.
Right. Exactly.
So call me crazy, but I've never had anything in a contract that's been personal property. It sounds like, is that correct? I mean, I've just never put it, I've never written it in.
Well, you're very good. We like you. We have to deal with this all the time. Probably, I don't know, 20% of the time I'm calling agents and saying, hey, get that out of the contract before it becomes a permanent part of our file.
Now, let me ask you this. What I do is I write all appliances to remain in as is condition with no additional value added to the sale as a convenience to the seller. I mean, is that along the lines of what you're talking about?
Nope, appliances are completely fine. Pool equipment is
Correct.
okay. But
Okay.
if they're leaving, if they're leaving the pool equipment and they're leaving, all of the outdoor furniture, I wouldn't put that into a contract, or I would address that. So whatever makes sense to be left with the house to operate the house is really kind of what they look at. Furniture, isn't. All right, so we have to be careful on those concessions. Fannie Mae and Freddie Mac and FHA, they're very, very clear on it. So pick up the phone if that is the situation. Pick up the phone and talk to whatever lender is working on that transaction and ask them for the best approach. But the easiest thing is to not put it in the sales agreement and do it on a separate addendum and have them buy it for something. Okay.
So Cherie, and this might be a legal question. When it's on a separate addendum, the Fannie Mae isn't looking at that separate addendum?
Well, I'm sorry, I shouldn't say addendum. I should say separate contract. Thank you for the
Separate,
correction on that.
yeah, separate from the entire sale.
Correct, separate from the
Okay.
entire sale. Thank you for that clarification. Okay, any questions on concessions versus contributions? Okay, so let's go into the maximum seller concessions. On a conventional loan, if someone's buying a property for non-owner occupied for investment, the maximum the seller can pay is 2%. Now, let me quiz you guys a little bit. Can you use gift funds on, and if someone is purchasing an investment property, let's say they're putting 30% down, what would you think?
No.
Nope. I heard one nope. Anyone else want to weigh in? Okay, you are correct. Nope, no gift funds for any part of that transaction. And a lot of people will use, they'll use all of their cash for the transaction, but then they have to have a certain number of months worth of payments in reserves. And what you want to make sure is if they don't have it and they're going to be using their 401k or retirement, make sure that 401k or retirement is allowed to be accessed for purchase of an investment property. Typically, every single one I've ever seen you can use for owner occupied. I've never found one that you could use unless it was an owner occupied transaction, or they could take a loan against it for any reason. That's a little glitch that I've run into over my years. So I thought I would just pass that along. Primary and secondary homes, less than 10% down payment, max contribution 3%. If they're going from 10% to 25% down, maximum 6%, and 25% or more down payment, 9%. Okay, let's talk about that for a second. So what seller would ever go up to 9% on the seller contribution? Can you think of anyone? Certainly not in this market. Or even for that matter, 6%. Kelly, did you have something to say? I saw you came off mute.
No, sorry. I think I was just bouncing back and forth on my car.
Oh, okay. So 6% is a pretty hefty contribution in today's market, isn't it? All right, today's market is not going to last for forever. Eventually, God willing, the market's going to stabilize and it's going to balance out. And it may know at some point it's no longer going to be a seller's market. It will either be balanced or it will go to the buyer side. So I think that's kind of interesting because I also believe, and we were talking about this before we kicked off the call, Anthony and I are both advocates of the fact that rates are probably going to go up. Anthony, would you agree with that? Okay, he may not be able to talk because he's tied up in a doctor's office right now. But even the Fed's saying that. So when the market changes and interest rates get up there, you may want to get a little bit creative with your marketing of a house, especially if it becomes a buyer's market, and just talking about the seller will buy down your interest rate. If you're putting down more than 10%. And the point of that is to try to get, spur on more interest in your listing. So I thought that was kind of an interesting thing to look at. Okay, on FHA, it's 6%. On USDA, it's maximum 6%. I'm going to give you a fun fact on USDA. Has anyone ever done a USDA on the call?
I have not.
I have.
Okay, so here's an interesting thing with USDA. if and these little fun facts are great because there are things that you can use for a marketing tool to go out and try to, increase some interest in the buying market, especially if you're in areas where USDA is eligible, which is a lot in Rhode Island, a lot in Connecticut, and a lot of you are Connecticut licensed as well, is that if the property appraises for more than the sale price, and this is the only time I've ever seen this, but if the property appraises more than the sale price, the buyers can finance their closing costs into the loan up to the appraised value. So that's one of those quirky little things, that's kind of cool to know, because when you're out talking to, potential sellers or potential buyers and you're trying to show them, how knowledgeable you are and why they want to work with you, to have some of these little facts will impress people. They'll think, wow, I need to get this person because, they're looking very globally. So that's kind of a little fun fact on USDA. Anyone have a question on that? Is that confusing?
No, very cool.
Okay, awesome. And then Rhode Island housing, it's the same with you doing a conventional Rhode Island housing, FHA, VA, or USDA combined with Rhode Island housing, they revert back to whatever those concessions are. Is anyone on the call, were you aware that, and again, this is not as prevalent in today's market, but going forward, we're not going to live in this market forever. Was anyone on the call aware that the seller can pay off some of a veteran's debt to help them qualify for a VA loan? Was anyone aware of that outside of me and Anthony?
I did not know that. That's
It's
cool.
it's a very cool thing. And the thing about that, again, it's like one of these things that you may never use, but to have that knowledge in your tool belt really makes you look like you know what you're doing. And you probably do know what you're doing, but it's just one extra thing. So there's and that's,
Interrupt. How would you incorporate something like that into a transaction?
you put it right in the contract. So that's considered. So remember we talked about the difference between contributions and concession. That's actually a concession, but the VA allows the concession. It's the conventional loans that do not. So you would put in there, and that 4% is not the same as, so you could do 4% towards their debt plus the seller can pay standard closing costs. The standard closing costs that every mortgage has. And it's fully disclosed and it's done at closing. So if the seller agrees to pay a buyer's $15,000 car loan off, it would not be done until the closing out of their proceeds. And that is allowable with VA. Cool little tidbit, yes?
So is that something, Cherie, that is, managed? Who manages that? I mean, how do you know that that happens?
Because we would require to see it on the closing disclosure.
The
Okay.
attorney
That
would
loan
actually
was being
take care of
paid off.
those.
That's interesting. So it's probably on the closing statement.
It has to be,
Okay, that's very interesting.
because they have to see, to exclude that loan from qualifying, they have to see that it's paid off, which would be done on the closing disclosure. Borrower gets the payoff statement, et cetera, et cetera. Okay, kind of cool little tidbit. There's so many things out there that we just don't, until we run across them, we don't know about them. Frankly, some of these things that I've found, it's because I'm involved with this real estate school now and teaching all these classes, and it's kind of humorous because as I'm going through all of the little print guidelines that we kind of never look at, I'm like, oh wow, I didn't know that. Oh wow, that's great. So interesting. Again, just more for your tool belt. Okay, big Anthony, big problem. Excess seller contributions at closing.
Giant problem.
Giant problem. So
Giant.
Giant. So there are a couple of things here, and this is why I put this class together. And by the way, as stated when Linda went out there, this is an approved CEU class. So if you do want to get the 1 credit towards your 2022 requirements, you can go onto our website and you can register for the class. And we gave a $5 discount for anyone, as a courtesy for being a member. So just want to let you know that if you want to do that. All right, so excess seller contributions at closing. If you would have if you would have gone through the Kahoot, you would have seen one of the answers that was not correct was the seller can just write a check to the buyer for the difference. All right. Now, does that happen? Oh, I'm sure it does. I'm sure I never want to know about it, but I'm sure it happens. Because if you're $1,000 or $2,000 where you can't use that money, that's hard for a buyer, especially a first-time buyer who scraped up every single penny. They just kind of paid 1,000 or 2,000 more for the house than they should have. So it's really important to consider a couple of things. Number one, when you call the lender and say, what are the total closing costs and what are the total prepaid expenses? So we can add that in. We really cannot give you an exact figure. Here's the double-edged sword, especially on an FHA. The buyer pays for their appraisal and their credit, anything else out of pocket. That cannot be reimbursed to them at closing out of the seller contribution. So if you're factoring that in, they're going to probably lose that portion. The other thing on a loan estimate is we cannot factor in any credits back from the seller. For example, quarterly tax payments. Because in Rhode Island, taxes are always paid for in arrears. So unless you have a seller that prepays their taxes, which is unlikely, they're going to be giving a credit for the amount of time they own the house, but the taxes weren't paid. So let's say you have a loan estimate, then you're asking for and it's $8,000, and you're asking for an $8,000 seller contribution from the seller. Then all of a sudden, by the time you get to closing, you can't use 2,000 of that. The double-edged sword for us is if the buyer doesn't have any money, we have to show that the seller is going to pay the full boat, even though it may not be the full boat at closing. Are you guys following me? Because I know that's really confusing. Can I get a yay or an A?
Yes. I'm following.
Okay, so you got to figure this out up front to not lose any money, okay? So if the entire closing cost credit cannot be used at the closing, the buyer will lose that money. Now, could they renegotiate their rate and point options? They could. They could come back in, they could change their interest rate, add points to it, reduce their rate, add points to it, but that is going to delay your closing if you take that approach. Can you change the sale price? You can, but that's going to delay your closing also if it's happening on the day of closing, which is often when we find it. So why would it delay? You got to drop an addendum to the contract. Loan has to go back into underwriting. Have to get an appraisal update, all those kinds of things. So, and then again, as we talked about, any paid outside of closing items cannot be reimbursed by the seller. Now, and one other point before we discuss this a little bit further is, and I'm sure Anthony would do the same thing, especially if you have a closing cost credit, never have the buyer pay for their insurance prior to closing. Always have it come out at the closing. And that way you can definitively use any seller contribution to pay that. Okay.
Every time.
Every time, exactly, Anthony. We do that every time. Don't pay the insurance. When we say don't run your credit, don't apply for a furniture loan, don't buy a car, we say don't pay for the insurance. So what do we do about this? What can we do?
Hey, Cherie,
Yes.
it's Paul. I hope you can hear me.
Hi, Paul. We
I-
can.
My phone is funny. I don't know what's going on. Something's goofy with it. But so it's my understanding, and I remember this from another training, or at least I think I'm remembering it. I could be wrong. Can the buyer purchase insurance for the following year? Can the buyer purchase lawn maintenance for the year? Can the buyer purchase grass maintenance? Can they use that excess money for something else?
Technically, no. Now, let's say, Anthony, you want to come on and address that? There's a couple of things that I know people have done, like maybe prepaid a huge oil delivery. And so that goes on the seller side and they cut a check to pay the oil company.
HOA dues as well. You can see that happen in that way.
HOA dues, yep, prepaying some HOA dues, not 2 years worth.
You'll also see sometimes, it depends on the attorney and the conversation they have with them, but maybe they'll pay that, but it won't necessarily be on the CD or the closing disclosure. I might just do that separately and write a check in order to do it afterwards.
So you have to get a little bit creative, like what do you do on the day of closing, but what can you do to prevent this? Okay, any ideas on that? And this is really more for the buyer's agent than the seller's agent. I mean, the sellers, they'd be happy not to have to pay all the closing cost credit that they agreed to. What do you guys think?
I would underestimate.
But what if the buyer doesn't have enough money to get through underwriting then? That's the double-edged sword. So the
Well, I
buyer
mean,
needs, go ahead.
the question becomes, if you're going to say closing costs are, $6,000, let's use a number of 5,300 to make sure you're safe. I know it's not going to be over that. I mean, they don't want to lose money, so I understand what you're saying, but you've got to pick a number. At the end of the day, you've got to get as close as you can.
And that's where the challenge is. Anyone else? I have a couple of thoughts on it. Anthony might have a couple of thoughts on it as well.
So Cherie, let's talk about the challenge piece of it. I would tend to think that the lender would be helping the buyer to think about how they could get that, to that figure well before the closing table.
Yeah, those are the kind of things I'm thinking of. So one of the things, if it's $100, who cares about $100 in a 6-figure transaction? But if it's substantial, one thing that can be done is a preliminary closing CD from the attorney when they've run the title. And so they have everything. This is typically prior to closing. And at that point, you're going to know. So if you're very proactive in the transaction and you know at that point that you have excess funds, you have time to do something with it. The problem is, and there are things that can be done, changing the sale price could work. Because you need a couple more days to make those changes operationally. The key is being super proactive on it and not just letting it sit. Because I don't remember who said, well, let's underestimate it. That could be a challenge too, because there are a lot of buyers out there that have 1 penny left after closing because the seller's paying everything. But if we're going to underestimate it and a loan estimate is going to show that the buyer needs to come in with 1,000, that's going to be a problem in underwriting. So when you have a situation where you've got someone who's tight on funds, I would say definitely go ahead and, go do worst case scenario with the understanding that you're going to get a better handle on the closing cash needed for closing before the closing so you can make some adjustments. Because there is nothing you can do at the closing, and that's the point. Unless you do something outside of closing, and just be aware that all parties are signing affidavits saying there's nothing else going on that's not disclosed in the contract. So this is one of these things that's a real pain point, and the best thing I can come up with is to be proactive. Anthony, what's your thought on that?
I generally feel the same way. I'd rather over than under. It's tough. It's especially tough when you get to something like an oil tank or paying for oil that's in the tank, or the credit for taxes, especially if it's, a 3-month away or a month and a half away closing, that they could pay another set at that point. Not knowing that stuff in the beginning, we don't know that. So when we're gauging and we're going, well, these are the closing costs, and then you want to do a year worth of insurance. So let's just estimate what that is, not even knowing at the time. And then from there, then say, all right, let's also build up your reserves in case you're escrowing. What's that going to take? What range, what dollar amount will we be around? And I usually add a little bit more on top of that, just to be sure. Because like she said it's easy to come back down later on as we're going through once the attorney has done their job and told us the information.
Yeah, and when you shortchange it and then you tell the buyer, look, I know you're not going to need this 1,000. We get it, but it has to be what it is on paper. Go out and get yourself a gift and tell them you probably won't need to use the money, but they still have to go through the process. You're still unnerving them. And so we want to keep people as calm as possible Oh, that's Denise. I'm like looking at the name Kathleen. Hey, Dee. um, so being proactive before the closing, give at least a week before closing, all of those numbers should be available. Okay. But that is a huge, it's again, I came up with this stuff because I went and did some surveys. What are some real pain points that agents could possibly help with to make it easier for the transactions? Okay. And that is a real pain point. So I think Kelly said, yes. Has anyone else ever dealt with this at the closing excess? Today's market, you're probably going to have to go back in your memory banks because very few sellers are paying closing costs today. But all right, so let's go into amendments. Here's another kind of sticking point. Often changes will be made to the sales agreement. Okay, dates, closing costs, credits, and sale price based on home inspection names, etc. So, the home inspector comes back with and says, these items should be addressed, and the buyer says, I want these items addressed. And obviously you can't put a work credit on the closing disclosure, so they will add a closing cost credit to kind of cover that dollar amount. But they forget to let the bank know, and they forget to let the attorneys know. So all of a sudden we're going to closing, and then they're saying, well, wait a minute, the seller's paying $5,000 towards their closing costs. Everything's going to have to stop on a dime, back into underwriting, back to the appraiser to notate that, etc. Okay, so it's really critical that any amendment you make to that sales contract needs to be forwarded to the people that are processing the transaction. And if you're not sure if they would need it, like, don't send a home inspection addendum to the bank. Just don't do it. Or the not an addendum necessarily, but you know, um,
When
copies
people
of
include what it's
course.
for, maybe.
Well, yeah, it's like
Does
do
that
it. Do
become a
it.
problem?
Yeah,
Ten
don't
thousand
do it.
dollars for a new boiler.
Exactly. I would probably say $10,000 for its closing costs. Anything that you put on that sales agreement is going to tie and bind the underwriter's hands. So if it needs a new boiler, oh, all right, here's a horror story. This is a real horror story. In the age of digital mortgages, buyers are actually tapped. Anthony, are you guys on digital?
We are.
Okay, so here's what happens. Buyers now are uploading their documents into their computerized loan file. Once a document goes in, cannot be removed. So if you're thinking, I wonder if they need this, send it to your loan officer for review via email. Do not send anything directly in. Here's a situation I had, and it turned out to be an absolute nightmare. The buyer, we asked for a copy. This was a VA loan. All right. We asked for a copy of the termite inspection, which is required on a VA loan. The buyer didn't understand that, and the buyer sent us the entire home inspection. And he sent it in through the portal, so everything has to be reviewed. The appraiser did the appraisal. There were no property conditions on the appraisal, but because we had the home inspection report with glaring items, we had to require that stuff being done. And that was after a $5,000 closing cost credit was given because of home inspection issues. Now we were able to close with an escrow, but everyone was really unhappy at the end of the transaction, and none of us want that. So be very careful about what the buyer sends in, because if it comes to the loan officer, if I get a home inspection report, unless the buyer meant to send it to me, like he wants me to use it, to, I don't know, get him out of the deal, which he doesn't even need us to do that, I don't even read it. I call him and say, hey, is there a reason you sent this to me? And he goes, oh, you don't need it? I said, nope, okay. And then I just delete it. You never want those kinds of things to be uploaded into their permanent file.
Cherie, can I ask a question about
Yeah.
these purchase and sales agreements that have, you know, a contingency on the appraisal. Whereas they, you know, the buyer will pay if it comes in under the purchase price, if the appraisal comes in under the agreed purchase price, and there's an amount of money that the buyer is willing to pay
For a
up to,
deficit.
yeah.
Yep.
How do you as a lender deal with those kinds of
That's fine.
contingencies?
As long as they have the cash, we just have to verify they have the cash to do it. You know, if a house appraises low, it does not stop the bank from doing a mortgage. If the buyer has the cash to cover it, so it doesn't change the terms of his loan, we're fine with it. And we see that. I've seen properties, you know, in this crazy market as it was coming up, and people didn't care, but they were paying it. You know, there's so much passion being used as a driver in this market. It's kind of crazy, but nope, not an issue to us.
You
Okay.
just verify, you verify the cash.
We have to verify it, yes. So if the appraisal comes in low and they agreed to a 5,000, you know, they would cover a $5,000 deficit, we have to see that they have the 5,000 cash over and above what's needed, you know, for their regular down payment closing.
Loan to values, okay.
This is Paul, can you hear me?
Yes,
Can I just add that the agent should also verify that those funds are available even before you ever get to that
yes,
point?
really good point.
Absolutely. I had a $50,000 appraisal gap on a property, and I said to the buyer's agent, I said, fine, send me proof of funds that your client has the 50,000 in cash. And the agent must have thought I was talking like I was from Mars. So, and they couldn't produce it. So,
Yep. Crazy times we're in.
oh, yeah.
All right, let's talk about insurance. Oh, do we really want to talk about insurance? Are you guys aware of the changes that took place about 2 months ago in the flood insurance industry? Anyone?
We had a
No,
class on it.
please advise.
Oh, you had a class on it? Okay, it's very ugly. It's very, very ugly in terms of the cost. So, you know, we're just going to jump right in. Flood insurance, that's got to be looked at right out of the gate. Now, if there's currently flood insurance on the property, you can check with the carrier, because if you're going to like assume that policy or carry on that policy, it'll take a longer time for that policy to double in cost, but eventually it's going to get there. I was really surprised that the NAR did not stand up against this. That was one thing, because flood insurance is a major thing. So homeowners insurance, I have people that come in and they say, no, I'll be able to get homeowners insurance for $400, and they're tight on their numbers. And I haven't seen a $400 insurance policy in years. Has anyone else? And
Only if
now
it's HOI, HO6.
an HO6 policy, that's about it,
Only
right?
on it, only, yeah, exactly.
Exactly. So, you know, especially when you have someone that's tight on numbers, rates are going up. I think that premiums are much higher than what they're going to expect. And especially if you have someone with marginal credit, they have the ability to get a mortgage, but it's going to substantially impact what the cost of their insurance is. And I've seen some outrageous insurance figures coming in, thousands of dollars. So these things need to be done right up front. And, you know, we really basically have to say to the buyer, find the house, negotiate, do your home inspection, apply for your mortgage, and the very next day, start shopping your insurance, especially if there's flood. And the other thing I'm going to say about that is there are some larger companies out there that want copies of home inspections to be able to rate a policy.
I've had that a couple of times,
Yeah, that's a little scary, Kelly. There are,
especially with historic homes.
oh, really scary. Yep. There are companies you can go to not have to present a home inspection. Sometimes they want a copy of the appraisal, which I don't think if that's what they need to find coverage. But some of them do ask for home inspections, and I definitely would not allow that. Okay, so insurance, big, 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 huge, humongous. Work on that up front, because you hate to see a deal die at the very end because the cost of the insurance came in so high.
Cherie, I would just like to let the audience know that at our new member orientations, we have Mary Caruso, who is one of our affiliate members, business partners. She's with Carrie Richmond and Viking, and she does a presentation on homeowners and flood insurance. And she tells them right up front, you need to do this at the very beginning. Your clients need to research homeowners insurance immediately, so that, because it could affect qualifying.
Yeah, and the other thing too is, we don't want shocks towards the end of the process. It impacts, how they feel about how everything went in their home purchase. So we want to shock them as much as we can in the beginning of the process, and get that stuff over with. So I'm in 100% agreement with you. We give buyers, in our mortgages, it's right in the stuff, they have until a certain day, and we don't give them much time. Now, a lot of them don't read it, but still, to get us a homeowner's insurance quote for that reason. So
Are we able to touch back briefly on the flood again? Because you mentioned that this was something new within the last couple of months, and that we can expect newer policies to double within
yeah.
some recent time. Okay.
double and even higher. And this is all through NFIP, National Flood Insurance Plan. It is all through them. And this got passed, somehow this got through Congress. It's really going to impact properties that need flood insurance. It's huge. And so if you had a $900 policy, it could possibly go up to $4,000. I mean, it's huge. It's huge.
For existing policies or for newer ones?
Nope. Existing policies are going to take gradual increases to get to the top level that a new policy is going to come in at.
I see. Okay. And
So
were there any other changes, like with drawing lines or anything
Yep.
like that?
Yep,
Okay.
they're remapping everything.
Is that already in effect? Not to get into the discussion, but
it is in process, but they are doing, I don't know if they're doing it across the country, but they're always looking at changing the zoning on these maps or the flood zones. So yes.
Okay, thank you.
Okay.
Kelly, just a reminder that whole Mary Caruso's full presentation, if you want to go into more depth, is on the website. It's on our website from the last lunch and learn that she did.
Appreciate that, Anthony. I will check that out. I wasn't able to make that class. Good call.
Yeah, Kelly and everyone, I'm not an insurance person. I'm not an insurance expert. So I can give you the general parameters. I can tell you that it costs a lot more. Define a lot. It's going to be based on the zone, but it is ridiculous. The increases. Well, who was on that call? Aren't the increases more than double what they were before this went into play? Anthony, do you know, or Linda, do you remember
It's going to be a little off. It depends on, so there's two different ways to thought of it. Because one, you have the regular flood insurance coming in. There's also third parties now, like Lloyd's of London, who are starting to do policies. Mary talks about that a little in her presentation as well. But not all of them. There are going to be changes to some people. There will be decreases. It's all about mainly the fact that this $1 million house and this $200,000 house are having the same amount of policy and trying to level that out to a better degree.
It's unfair. It's unfair.
It is.
And I
Very unfair.
recommend that, in addition to reviewing the presentation that Mary did, is to reach out, Kelly, to, your insurance consultant and have a conversation, whoever it is that, I'm sure you have a few consultants that you can reach out to. Have a conversation.
Yeah, it definitely something very, very important to get your arms around, especially if you deal in coastal areas of the state. But it's not even just coastal areas.
No,
I
it
mean, you've
isn't
heard
just
of
coastal areas.
it's not
A good chunk of Rhode Island.
good chunk of Rhode Island. Okay, so let's head into I kind of want to leave some time for where are we? Okay, we're getting close. Cesspools and sewer connections. The requirement to install a new septic system per the law will vary from lender to lender. It is the responsibility of the owner to comply. So for the most part, we're not lenders for the most part will not hold up a closing if the borrower has sufficient funds remaining to put in the new system. Anthony, this has never come up in anything since in my world, since coastal wetlands came up, with this mandate. Have you had any issues with this?
This is the switching from cesspools over to septic systems by
Yes.
closing. Yes.
Yes.
So yes, I've dealt with this several times. Actually, we had another training about it, or in one of our other classes, we discussed it too as well. So generally speaking, and this is actually, I was going to bring this up with your amendments one. So I've had recently, or not recently, this year, I had somebody who the sellers were responsible for changing over the system. They had to get a bid on it, and then they had to do an escrow holdback for 1.5 times what the bid was. That's generally how it happens. So the attorney will hold it, the work will be completed, then it'll be issued out. During the process, they switched that and made it the buyer's responsibility and did not let the lender know. Very important.
Ooh. Yep.
Change everything around because now got to verify my buyer has their sufficient funds in order to do the work. And additionally, they'll have to bring 1.5 times whatever that work is to be completed to closing as well. And it will be held by the attorney to make sure it guarantees it gets done.
So that's a little bit different from lender to lender, but the bottom line, and it's really frustrating because I have not heard that coastal wetlands management is even following up on anything to make sure it was done. And it came out years ago, didn't it? Like 2013 or 14 or 15, something
Yeah,
like that.
it's been, I think even longer than that. It's been out for a while now because that was a big topic study in 6, 7, maybe it was 14 or so.
Yep. All right. So if your buyers don't have the money to do it and your lender's requiring something, there are easy programs out there that you can use. 203K construction rehab type loans. You've got rehab loans on the Fannie Mae Freddie Mac side. You also have it on the FHA side. And did anyone know that VA also does rehab up to 35,000 renovation?
Didn't know that.
I did.
Is that on single family only?
No, I don't think so. I'd have to look at the guidelines, but it's VA does have a rental program as well. Not
Cherie,
everyone
I
does
think
it.
some municipalities also have some grants for properties that need to install a new septic system.
Okay. Good thing to check into. Here's a key thing about, I'm sorry, did I interrupt someone?
No, I was agreeing, although I do have a question before we move on from insurance. It's not urgent.
Oh, go ahead.
My question is, and it might be in particular to the flood, but are there particular types of loans that may require more insurance, let's say particularly on the flood, than others? An FHA versus a conventional loan with a lot of, for instance.
Yep. No, it's going to be the same. The cost is going to be the same across the board. It's going to be based on the zone and the maximum insurance available, like just for regular single families, 250,000.
Okay, got
So
it.
if you're buying a house for 300 or buying a house for 2 million, you still only have to cover 250,000 because that's the maximum
Right.
available through the NFIP.
Got it.
Okay, in terms of additional insurance though, the only thing I can think of is if you're doing some kind of construction loan, not necessarily a rehab, a 203K, but there are some great construction loan products out there. Sometimes they require a builder's risk policy. That's the only thing I can think of that would be out of the norm.
Got it.
All right. So the other cool thing is, I don't know, it's another one that you may or may not know. FHA sewer connection is required by FHA if available. If not available, a septic inspection is typically required, but FHA does accept um, all types of sewage systems, and they don't require inspections by guidelines. Some lenders might require them. So if you have a cesspool and there's no sewer line available and the appraiser does not indicate that there's a problem with the cesspool, you should be fine with a cesspool per straight FHA guides. But if sewer is available and you have an acceptable system and it would be a financial hardship on both the buyer's or seller's part, you can get a waiver of that connection. Are you guys aware of that? That's another one of those interesting things.
And that's across the board?
Well, it's hard to say it's across the board. That's FHA rules. Because what happens is different lenders apply overlays to the standard guidelines. For example, most people think that if you have a non-owner occupied cosigner, you can only do that with an FHA loan. But you can actually do it with a conventional loan as well. But most lenders put an overlay on that guideline. So I always tell people, never accept no on the first round, start calling around some resources, because most lenders apply multiple overlays to the standard guidelines. That is the FHA guideline. Does that make sense, Kelly? So not every lender might do that. They might say, nope, we won't do that. It's
Right.
one of those things.
Got it. Okay.
Okay. All right. So what can delay or force or stop a closing? Borrower changes or loses their job. Honest to God, I cannot tell you the number of times someone changes their job, but they are afraid to tell me because they think it's going to hurt their mortgage. But we're going to verbally verify their employment. We're required to verbally verify their employment right before closing. Now, does it mean they won't get the loan? No, not necessarily. Will it delay the closing? Absolutely. Okay. I'm amazed at how often this really does happen, where they don't tell us because they're afraid. This is a big deal. And usually it's not a problem because typically it's not a problem. But people will go to Cardi's or they'll go to Jordan's or something, and they'll maybe set up an account for new furniture to do something after closing. Right before closing, we're going to repull credit inquiries on that customer. And we're going to pull it from the date of their last credit pull. And if there are any inquiries, the wheels on the bus stop. And now we have to go back and verify they did not take on any new debt. And sometimes they said, well, I did, but I don't owe anything. And now we have to get documentation showing that they don't owe it. The problem is they haven't gotten the card yet or the account number. So we have no way of verifying it. So the easiest thing to do is to say, don't let anyone pull your credit for any reason, nothing. Okay. After you close, have at it, go apply, or have anyone pull your credit. That is and the other pain point about it is that, we're calling and saying, hey guys, we're submitting you for a clear to close, you're on the home stretch. And then all of a sudden we have to call them and say, hey, did so-and-so inquire into your credit? Oh yes. Okay. I need documentation on what happened, or I need a letter or something. It takes the wind out of their sail. So anything that we can do to keep the wind in their sail so they're happy at the end, that's most important. So no new loans, furniture, appliances, no work credits. We already talked about that in pretty good detail. If their work credits will not go for any kind of mortgage, period, end of story. If it's on a contract, you're going to have a problem. If something needs to be done as the property and you can't do it via a closing cost credit, adding a closing cost credit, you need to renegotiate something because it cannot be shown on the CD. No escrow holdbacks for the most part, 99.9% of the time. What's the 0.1? Well, let's say FHA was requiring the exterior of the house to be painted, but it's January and it's not 50 degrees, so the paint won't stand. They'll do an escrow holdback for weather-related things. And that VA situation I talked about, we made a decision to do an escrow holdback on the home inspection issues because they were not appraisal issues. All right. So unless it's weather related, there's no escrow holdback. Borrowers short funds to close. Believe it or not, has it ever happened to anyone? They get to the close, they get their
Yes.
final number. It's, oh my gosh, it's horrible, especially if the bank knows about it, because now, again, the wheels on the bus stop and we have got to say, where's the money coming from? Go get a gift, go do this, go do that. And that's going to delay. And that is just, it's just a horrible thing. And again, a horrible end to the process for them. Final walkthrough issues. Anyone ever had issues on a final walkthrough?
No, not that I
You
can
mean
remember.
like that chandelier missing that was supposed to stay, or
Something of that nature, a hole in the
doors?
wall.
Yep.
Yep.
Not swept nicely.
Exactly. So it's kind of a good idea, you know, to, because especially if you're going from the final walkthrough directly to the closing, to have a plan in mind, because that can delay things or fights at closing, whatever. Okay, seller payoffs coming in higher than expected. Lower proceeds. Believe it or not, we see that, and I've seen some situations where the seller is scrambling to borrow money so they can get to their closing. Has that ever happened to anyone?
Before closing, yes.
Okay, so it's a really good idea to, again, as you are in determining, do you have too much seller contributions? You know, get a copy of the seller statement or see if the attorney has a payoff, being proactive versus reactive. Obviously, oil adjustments, etc. Unknown sewer assessment. I'm kind of amazed sometimes at how often that comes up. Kelly, did you want to ask a question?
Nope,
Or
all
say
set.
something? Oh, you have your hand up. You giving us a high five?
Oh, I think that's from before. I'll take it down.
Okay. Resale certificate on condos. If you don't ask for them in advance, and it's really hard because they're only good for a certain period of time, then you have to go in and typically you have to pay for them. But smoke cert, this happened to me last week. The buyers were buying a house they're living in. The buyers contracted COVID. We were supposed to close last Thursday because their rate lock was expiring on Thursday. They contracted COVID, and so the fire marshal would not go into the property. So we had to pay for rate lock extensions. So do things, I mean, how long is a smoke cert good for?
90 days?
Yeah, I'd probably do something more up front. These are things that I've seen or heard of that can delay or stop a closing. So, I mean, do you guys think we kind of hit all these? Has this been helpful?
Oh yeah, very helpful.
Okay, I want to, unless you have questions, we were discussing something and I just want to throw it out there. And I know we're 2 minutes over. Can I have another 3 minutes?
Absolutely.
Because I think that you're gonna look at this and say, this is great. Okay, so hang on a second. So where's our market going? What do you guys think? Where do you think our market is going? Anyone have an opinion on that?
I feel like we've had feelings on what it was going to do for so long now that we've given up predicting.
All right.
That's
so
how I feel.
Here, so I think that we need to be prepared. And I was showing this to Linda, and she thought that this was a pretty good thing to share. Linda, do you still agree?
Yes, I do.
Okay. All right. So we're coming into an interesting market. Both Anthony and I feel that you're going to see, well, we all said 2021, you're finally going to see higher rates, and then that didn't happen. Rates stayed low, but now there's enough factors in the market that most people are feeling that, yep, we're going to probably see a pretty good pretty significant increase in rates. So we're coming out of this, we still have this horrendous market. We still have inventory issues. All right. And now rates are going to go up. And I think we need to figure out how do we best counteract this. Let's couple that with, if you look at the models, you know, what's really kind of keeping the market and what's going to continue keeping the market going are millennials. Is that fair? You guys think?
Sounds
Anyone?
better.
Yes.
Sounds about right. Okay. So we have to get into the mind of a millennial. And there was a study that was done and some interesting results came out of it. Actually, there were two studies. One I actually share as part of a class at Rhode Island School of Real Estate. I'd encourage you to take it. It's going to give you an insight. Anyone on this class right now? Did anyone take the millennial class?
No, we've
No.
actually talked about putting one on, I think, in the past.
Okay, I know Thomas, you have. I see you on. Denise, you
Yes.
have. Yeah. So Denise, you're not a millennial. Can you hear me? Because I know you're on mute. Can you hear me? What did you? Yeah. Can you come off mute? You're still on mute.
Me?
Oh, now you're not. Okay. Yeah. So you took the millennial class. What kind of insight did it give it to you in terms of millennials and that kind of thing?
Well, millennials want to educate themselves on everything and anything, but they also need,
Right. Not specifically about that, but did you gain insight into them? Into the mind of a millennial?
they need a hand. They don't have,
Right.
a
No,
lot of
that's
them
not
feel as though they cannot, they need to be, their hands held by.
Yeah, let
parents.
me rephrase that. Did the millennial class help you get a little bit more into the mind of a millennial?
Yes, more so, yes, more so than
Okay.
the ones I have in my own family because they're not your typicals. And
Okay.
yes,
Okay, the reason I'm bringing this up, guys, is not because I'm pushing the class, although it is a really good class, or I'm pushing the school. It's a class that you should take. First of all, you get 3 credits for it. Secondly, it's going to put you in the head of a millennial. And there were 2 major studies done, and I was shocked, and they were done by a PMI company. I was shocked by the results of this. And why is this so important? Because if you look at 7 leading forecasters on where the market is going, what's going to keep our market alive is millennials. Okay. So we need to understand them, embrace them. And I know, Thomas, you're a millennial. I know that. And for anyone else on the class, but you understand where they're coming from, and you have to understand where they're coming from in order to best serve them.
Kelly, you're a millennial.
Yes, I am.
Yeah.
Okay. Kelly. All right. So Kelly, take the millennial class because I think it will give you even some insight. Thomas,
will.
Thomas is a millennial too. Thomas, you going to weigh in on this? I don't see him coming off.
Yeah, no, the class was great. I mean, just as somebody who's personally never bought a house but sold a lot of them, it helped a lot with helping my friends and getting them into the thought of buying versus renting and getting them out of the mindset of that.
Okay, here's the reason I'm talking about this. Here's what millennials know. First of all, you'd be shocked at the statistical data about how they view real estate as not being a good investment. Okay, that's number one. They typically, and again, not every one of them, but these are the majority of, they surveyed owners, potential buyers, and non-buyers. They feel that they purchase a home because it's the right thing to do when they turn 30 or if their needs specifically change. In their lifetime on earth, what have they seen in terms of the real estate market since they were an adult? You know, what have they really seen? We came through a horrible time out of 2008, foreclosures, short sales, bankruptcies. Everyone with me?
Mm-hmm.
Okay, so this is what they know. And this is the thing, we have to understand what they know. And I think that's one of the reasons that they're not viewing real estate as a good investment, because they have a very short time span to make that judgment. So we really have to educate them globally on a real estate investment so they see it from a different light. And what I'm going to share with you right now. Now, I didn't complete 2021, but I just want to show you when these rates start going up. And Anthony, you agree with me, they're going up, right?
Gotta get to my unmute. Yes, I agree with you.
Yeah.
We've discussed this earlier.
And that's what all of the financial people. Okay. So are you seeing a rate chart in front of you?
Yes.
Okay. I've looked at tracked rates from when the secondary market, this is Freddie Mac, first came really into the lending industry. So it starts in 1971. So in 71, 7.5, 7s, 8s, going into continuing on in the 70s, 9, 8, 9. Then look at this, 10, 15, 12, 17, 16. The thing is millennials and most people look at this and say, wow, I had no concept. All right. And then as you continue to track them, you get 9s, you get 10s, then they started coming down. Who was in the, well, they started coming down. And Anthony, I don't know if you were in the business back then, but we had people, literally, we had to lock the doors because they were lining up because they wanted to get from 13% to 10. And then they wanted to get to 9. And then they refinanced down to 7. When you see these huge shifts, but the bottom line is rates are not guaranteed to stay at 3%. And history shows us that. Okay, so then we get into 1989 through 1993, the hovering, they were like 10 and 4s. And by the way, let me point something out. Do you see this column points? To get a rate of 10.48, they had to pay 2 points, not 0 points. Today, for the most part, everyone's doing 0 points. So if this were the case, then I'm going to guess that the 0 point rate around this time was maybe 11.25 or 11.5%. Okay, and then we
And
continue
we're not even
on.
talking about adjustable rate mortgages.
No.
I mean,
These are 30-year fixed.
exactly.
So then we get to 2004. Okay, so mid 5s, high 5s, 6s, and then we have the meltdown, right? We have the major meltdown in 2008, and look at what happens with rates. Do we see anywhere 3 or 4% going back to 1971? I'm telling you, it's not there. I don't know how big this is on your screen. So this was a major meltdown, okay? And it reflected in the rates. And then they came up a little bit, came down a little bit. And here we go with kind of where they've been over the past couple of years. Why am I showing this to you? As you can see, I've got it fill in from March through December. Because here's what millennials know. Since they've been paying attention to rates, let's even go back to 2012, to the last 8 years. 3s, and sometimes, we saw in the high 2s. That's where their head's going to stick. So it's really important to understand that they don't have a concept or a clue that rates could go well beyond. And we need to make sure that we're educating them, because we never want them to come back and say, I wish I would have understood that rates come up, so now I'm paying more for the house and a higher interest rate. Or even, trying to deal in this market when people may be jumping off the fence because of the high market. I'm just going to wait for 6 months. I'm going to wait for the market to change. Well, if the predictions are right, yep, the prices of the houses might come down a little bit, but it's more likely now than it has been in the past few years that the rates are going to come up. So they're going to end up paying more for the same house. So I just wanted to show this to everyone, just because we have to remember that we are not guaranteed these lower rates, and understanding that millennials, or anyone, because they've been low for so many years, are going to be our clients, and where our income's going to come in, we have to aggressively and proactively educate them. So I just thought I would show that, if you guys, just food for thought.
Very interesting. I'm surprised that millennials are hesitant. I know that we've seen the crash and what our parents in many cases went through, but to also see the appreciation that we've had since then and the rates going down. I mean, maybe people just aren't paying attention to the history of it, and that's just.
And because millennials in general, and you'll see the results of the survey were, eye-opening. Their misinformation, I can't remember the percentage, but I think it was over 72% of millennials thought they needed more than 20% for a down payment.
Mhm.
So these people, we need to bring them into the marketplace because they can be brought into the marketplace, but it's our job to go out and spread the word that, hey guys, there's grants, there's zero down programs,
Right.
because they're getting bits and pieces, but they're ill-informed is the best way I can put it. So it's these kind of things I believe, will help us, any tool that we have to educate them. So I know I'm over and I apologize, but I just thought that was kind of important to show that to you, to help in our quest to, serve more families and getting them into homes.
I appreciate you doing that
Yeah,
very
thank you for
much, so,
sharing. That's
Cherie.
great.
You're welcome. Any questions at all?
Not at this time.
All right. Any issues that you've had on a transaction that you'd like a couple of ideas? Because we have several people on this call, they may run into the same thing. Now would be a good forum for it.
I don't have anything right now, personally.
Okay. If not, Miss Linda, I will turn it back to you and say thank you for being a great group today.
Cherie, thank you so
Cherie.
much.
Thank you,
Thank you,
Cherie.
Jerry.
Anthony,
Yeah,
if you
learned a
want to sign off.
Sure. Not a problem. Now that I'm at a desk, I can actually do it correctly. Sherry, thank you very much for the presentation. As stated, the Kent Washington Association Education Committee puts these lunch and learns, or this is a Zoom and learn, on once a month. All these resources are available, as we said a few times during the course, online. You can view everything from the past year and a half or so that we've done, and there are some great topic studies. I want to thank Sherry for her expertise in this subject matter.
And Anthony, you for your input. Thank you.
As always, a amazing teacher when it comes to these classes, as we've done several with you in the past.
Oh, thank you.
That is all. Everybody, happy holidays.
Thank you. Happy holidays. Thanks again, Cherie.
Thank you.
All right. Take care, everyone. Be safe.
You too.
Bye-bye.
Likewise.
Okay.
Bye.
Bye-bye.